Okay, so we have done the hard part, right? We are through with the tedious and sort of mentally challenging calculations to figure out what all the appropriate and relevant cash flows are for our capital budgeting problem. And trust me, that's the hardest part of all of this. The rest of it is just techniques and skills and getting the computer to do your work for you. And so what I've done is copied these couple of tables over from your textbook. So this is table 12.5, I guess, down here. And we've got all the information from the purchase of a new machine and what the cash flows are going to be. So we have an initial outlay. If we look over here, we have an initial outlay of $62,680, and then we're going to have 5 years of $24,240 after tax cash flow, and then a terminal value of 18, which we add to that last year's after-tax cash flow. Okay, so this is our sort of profile of the cash flows associated with this investment. Now, your book likes to put things in columns like this. I don't. So here's what we're going to do. We're going to copy that. And we are going to do something called paste special transpose. So now we have a timeline, and for some reason the cell references aren't working right, so I'll just pick that up here and pick this up here, and there we go. So now we have our years. Time. Okay. So our cash flows are here. Now, the first thing that I want to do, you'll notice, of course, that I've brought you back over to the PowerPoint because we do have some content that we're going to go through here now. The first thing is that we have a number of different ways that can be used to make the decisions about whether it makes sense to make an investment. He's telling you that there are 6 commonly used profitability methods. I am going to focus on 2, net present value and internal rate of return. These are the ones, net present value, of course, you would have seen in a finance class already in 319. IRR, or internal rate of return, is something that I see used more often in the real world. So we'll focus on those. So your book and the homework exercises, they do have you calculate a payback and a discounted payback period. Again, I'm not going to require that, so when you go to do your homework, just ignore the payback piece. I will just address the question of payback is just how long does it take you to make up your investment, right? And you do see people using that all the time, but it is not financially sophisticated because it doesn't take into account the time value of money. And it does not take into account the fact that if you're going to have a big positive cash flow at the end, you should take that into consideration. All a payback period does is it just adds up, how much do you have left, right? And so, in the first year, you've only paid back 24,000 of what you initially invested, and so in the second year, you've still got almost $40,000 left. So in the second year, you got to see whether you've paid it back in the second year. The answer is no, and then you could carry this out to the third year, and so we know that somewhere between 2 and 3 years, we've paid this back. The exact precise question it's irrelevant, right? Because it doesn't matter. This $24,000 is not the same as this $24,000. And your book has you go through this whole big gyration of calculating the exact, percentage of a year that's involved in paying back an an investment, but it just doesn't make sense to do that at that level of detail because it's just not rigorous. Okay, so we are going to ignore payback. Goodbye. All right. Net present value, on the other hand, of course, is sort of the, I guess, the gold standard of figuring out what whether an investment makes sense. Certainly, it's something that has been used for many years now. The net present value, okay, it's basically a benefit cost calculation, and what this statement here is saying is it's the sum from t equals 1, right? So the sum of from the numbers starting across when the time is 1 of the discounted cash flow. That's what this is, cash flow at the time plus 1 over the rate of return times the time, 1 over 1 plus r to the n, and then minus your initial investment. Okay, so the benefits are here out in your future times, and the cost is here. Okay. Be aware that Excel's NPV function is not technically correct. The reason that we say that is because Excel's NPV is really just designed to take the present value of cash flows that are different from one year to the next. What you should do, technically, is use NPV to take these cash flows here and then subtract out the initial investment. So let's go ahead and just show that. Okay, NPV calculated entirely using Excel's NPV function incorrectly. Okay, and so we'll let the cost of capital, we'll let that be 9%. Okay, so all you do to calculate it, so here's our incorrect calculation. It's a very simple function. Go NPV, here's our rate, put in a comma, and just grab those values. And it gives us 39,756. The correct way to calculate NPV in Excel is you take the NPV of those numbers further out. Oops, I'm sorry, I need to put the rate in. The NPV of the rate, using the rate, and then of the numbers beginning in year 0. So that'll bring the value of these cash flows down to year 1, and then subtract out, I'm sorry, we want to plus the initial investment because we are adding a negative. So this gives us a net present value which is somewhat higher than this, and let's make that $1 so you can see it. Yeah. Okay, so our net present value calculated properly is almost $4,000 higher than the one that's calculated improperly. Okay, either way, this is a good investment. Because the thing is, right, if your net present value is greater than 0, then it's a good investment. Then you should go ahead and make the investment. Here's a question. At what point would it become a bad investment? So let's look at, when does this investment turn south? Okay, so we want to know first of all, let's say the net present value of 0, we can see how the net present value changes when we change our discount rate, right? So if we say it's a 12% required return, now it goes down, okay? Let's say it's a 15% required return. It continues to go down. So at what point is our net present value 0? Okay, so what we want to do, we want to use the goal seek function, data, what if analysis goal seek. We want to set the net present value equal to 0 by changing the discount rate. Okay, so at 30% return, 30% discount, we get a net present value of 0. Okay, I'm going to pause this for a minute and continue. Okay, the next thing that your book goes through is this idea of a profitability index, which, to be honest with you, I've never heard of before, so we're going to skip this too. And now we are going to go to the big daddy, the internal rate of return. All right, so this is precisely what we just calculated, right? We just did a goal seek to determine at what point we have a weighted average cost of capital or a required return rate, which is up here actually in our input sheet. At what point does the return on this project turn the net present value to 0? Okay, that is what mathematically the internal rate of return is. Okay, it is a measure of the average annual rate of return that a project provides. It's the discount rate that makes the NPV equal to 0. And if the internal rate of return is greater than the cost of capital, then the project should be accepted. So let's go ahead and pick up our discount rate, or our cost of capital, up here from our input sheet, which is 15%. So we're going to say this is our required return. All right, I'm going to take WACC out of here and call it required return. Okay. So now if we use this, we calculate a net present value of 27,552. And I'm going to also remove this incorrect calculation example. So remember, calculate NPV by bringing future cash flows down to the present value and then subtracting out the initial investment. Okay. So to calculate the internal rate of return, you could use a goal seek and change this formula until we get an NPV of 0, or Excel has a way of doing that for you via a formula, a function. So the IRR function in Excel. Okay, the way you do it is you go IRR, and the arguments are, you just take these values, there has to be a negative at the beginning, and then you have to start it, because what happens is Excel iterates. So just give it some value, any value, 1%, 10%. It's going to think, it's going to come up with the answer, and there it is. We didn't even see it think, 31%, which is precisely what we got when we asked to calculate the change of the return to get us an NPV of 0. Okay, so these are the two big daddy ways. NPV is more sort of for academic purposes. I see IRR used a lot more in the real world, and the decision is, if your rate of return is greater than your hurdle rate, then you should go ahead and make the investment. Easy. Okay, the hard part in all of this is just setting up the cash flows, figuring out what the cash flows are. The decision process couldn't be easier using Excel. Okay, so NPV and IRR are the big ones, and they're very simple to implement. Okay.